Welcome back to Price Action Trading Series from Market Secrets. This is episode 29 of the series, and in this episode, we are going to see how to identify change in the trend. Before we begin, I got a notification for you. So, Price Action Trading Series is just one of the series that we are currently running. In addition to this, we have Algo Trading Series, Trading Strategies, Investment Strategies, and Tax Saving Series running in parallel. If you are interested in any of it, you can check out our website for free learning of these contents as well. Our website address is www.marketsecrets.in. In addition to this, we have various data feeds as well, which will come in handy if you are an active trader. So check it out if you are free. And with that note, let's get into today's session. In the previous episodes, we have clearly explained what are the different types of trends, what is trend consolidation, and what are the criteria needs to be fulfilled for each of those scenarios. Now, let's look at what needs to happen so that we can clearly say that a new trend had started. Newton's first law of motion states that every object in a state of uniform motion tends to remain in that state of motion unless an external force is applied to it. It is pretty simple. A trend in any given time frame will continue in the same direction unless an external force, in our case a bigger time frame or an extremely newsworthy event, is applied to it. So a trend change in any given time frame usually happens when a bigger time frame gains control or some extreme newsworthy event happens. So let's take this a step further and see how a trend changes. In order to have a new downtrend after an uptrend, either one of the following scenarios needs to happen. One, a new bearish trend line can be drawn and at least one demand zone is taken out. Or number two, two demand zones should have been taken out. Now, don't confuse this with the rules that we have discussed during trend consolidation. This is different from the trend consolidation rule. It might look similar, but it is completely different from the trend consolidation rule. So let's look at this closely now. There are two possibilities here as well. Let's take it one by one. Possibility number one. A new downtrend happens when a bearish trend line can be drawn and at least one demand zone is taken out. For example, consider a stock is currently in an uptrend and the price moves down sharply and the bullish trend line is broken. Now the price is in bullish consolidation mode. Price then goes down further and at least one demand zone has been taken out. In the process, price forms a new peak, and if we can connect the two new peaks with a bearish downtrend line, then the time frame will now be in downtrend. The difference between bullish consolidation and a downtrend is possibility to connect two new peaks where the second leg of the second peak makes a lower low than the first peak's second leg. In simple terms, the difference between bullish consolidation and downtrend is nothing but you'll be able to draw a proper downtrend line. So if that had happened, we are now moving from bullish consolidation phase to an official downtrend. So from uptrend, it enters bullish consolidation and now it enters the downtrend. That's the flow. That's how the trend changes. This is possibility number one. And now the possibility number two. A new downtrend can happen when two demand zones were taken out. So there were times when the price sells off so fast that the drawing a bearish trend line connecting the latest two peaks is not just possible. However, due to the strength of the move, price can manage to take out two demand zones. When that happens, the two opposing demand zones has been taken out, then the chart will be officially in a downtrend. So this is possibility number two. Likewise, in order to have a new uptrend after a downtrend, either one of the following two scenarios should happen. Number one, a new bullish trend line can be drawn and at least one supply zone is taken out, or two supply zones were taken out. So let's see these two possibilities as well. So possibility number one, a new bullish trend line can be drawn and at least one supply zone is taken out. So, for instance, consider currently we are in a downtrend and price moves up sharply after that and bearish trend line is broken. And now the price is in bearish consolidation. Price goes up furthermore and at least one supply zone has been taken out after that. In the process of doing it, price forms a new valley, and if we can connect the two new valleys with a bullish uptrend line, then the time frame will now be in uptrend. The difference between bearish consolidation and an uptrend is that possibility to connect two valleys where second leg of the second valley makes the higher high than the first valley's second leg. So in simple terms, the only difference between bearish consolidation and an uptrend here is that we'll be able to draw a proper bullish uptrend line. If that had happened, we have moved from bearish consolidation to an uptrend. So initially stock was in a downtrend, it moves down, breaks the trend line, enters the bearish consolidation and then breaks the supply zone, and then it forms two new valleys, and if that had happened we'll be able to draw the trend line, and the moment we draw the trend line we are in a new uptrend. So this is the flow for possibility number 1. Likewise, let's see possibility number 2, which is two supply zone break. So in this case, two supply zones will be taken out. So there are times when price rallies so fast that drawing a bullish trend line connecting the latest two valleys is not possible. However, due to the strength of the move, price can manage to take out two supply zones. And when that happens, that is, if two supply zones were taken out, then the chart will be in a new official uptrend. Also, as always, please keep in mind the level on top of level scenarios mentioned earlier. All the level on top of levels will be considered as one zone. So you cannot take it as two different zones. So always keep this in mind. So now let's take an example in the form of chart and see this flow for any one of those scenarios. So if you take this particular example, price is now officially in a downtrend. So look at this part of the chart. Till here you can look at the chart. So we have two new supply zones and we have two peaks. We were able to connect both the peaks and we were able to form a downtrend line. Price is now in a downtrend until this particular point. Now the price breaks the downtrend line and goes into bearish consolidation. So if you look at here, the price started moving up from here, and at this particular candle the price breaks the downtrend line and we are now officially into bearish consolidation. And now the price continues to move up, but it couldn't break the supply zone here, so it dropped back again and then it formed a clean valley, and after that price shot up hugely and then it printed another valley, and in the process it took out the supply zone as well. So the moment price breaks the supply zone and forms the second valley, the trend changes. With these two valleys, we can now draw a proper uptrend line by connecting the valleys. So we can now say that uptrend has officially begun. So we connected both the valleys and we have drawn a uptrend line. So we can say that the uptrend has officially begun, but this uptrend didn't last so long and it was immediately broken and the price entered the bullish consolidation. But this is the flow. We were initially in a downtrend and price breaks the downtrend and enters into bearish consolidation, and then it breaks the supply zone and also it prints two valleys, thereby enabling us to form an uptrend line, and we are now officially in an uptrend. And that marks the beginning of the uptrend, even though it didn't last for too long. So this is how a trend changes. So it will keep on changing. This is how it will be, like, the moment you draw it, it might even break. That's completely all right. That is what will happen in a price action chart. Your duty as a trader should be to keep monitoring for any trend changes and continue to shift your trend lines and zones. That's what you should be doing as a trader. So this brings us to the end of today's episode. If you have liked this video, hit the like button and share it with your friends if you find it useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.